The Fed is committed to fighting inflation and bringing inflation back down to 2%. He didn't seem to care about the economy. He seemed steadfast in his resolve and commitment to get inflation down to 2%. And he said, we're nowhere near there. We got a long way to go. Now, the markets didn't really react to that on Monday, which was a bit surprising. But then today, we had a couple more FOMC members also talking, singing the same song. Nobody's worried about the economy. Nobody at the Fed seems to believe the economy is in recession, or at least they won't acknowledge that it's in recession. They're all on Team Biden, and they are towing the Democratic line. We have the strong economy. Just ignore what's happening with GDP. That's irrelevant. Inflation is the problem, and everybody is committed to bringing inflation back down to 2%, and everybody admits that the Fed is nowhere close to achieving those objectives.
You know, we've seen the Fed come in at various times in the last decade, maybe the last 20 years, but there's one thing that we haven't had when the Fed comes in, and that's high inflation. So this inflation is off the charts, and it really makes the Fed's job so much harder. And again, the Fed is not necessarily the end-all, cure-all for the market environment. Many people are speculating that the Fed's going to pivot just because we've seen a few economic reports come out showing that inflation is starting to moderate. Yeah, I think inflation peaked with the June CPI report that was released in July. And the Fed says, well, we want to bring inflation down to 2%. You can't get inflation down to 2% and have the stock market go up and have rates go down on the 10-year and 30-year. That's not going to happen. The Fed is going to keep going and going until they bring inflation down to that 2%.
This time they hiked their rates twice. They started in April of 2011 and then the second one in July. So there was the second rate hike for the second time in July 2011. That did prove to be the second kiss of death because immediately bond yield, and I think that's another point you want to make here too, is that in 2008, believe it or not, the top in German bond yields is the day of the announcement. We have not seen rates that high ever since that point. The day the ECB announced the rate hike in July 2008 was the top in those yields. The very next day, interest rates in Germany, as well as around the rest of the world, plummeted. Despite the fact the ECB was saying inflation, rate hikes, all this stuff, the market was saying, whoa, this is a little too crisisy.
Everybody likes to beat up the Fed regardless of who's in that seat. But he's been doing a really good job and in my view, because he just doesn't know and doesn't say that he knows what's going to happen next. So he's trying to stay flexible. Rates right now are still at historic lows, even though he's gone through multiple rate hikes. The question is now, what's next? Many people think, well, another one is going to be at 1%. Maybe there'll be an emergency meeting, but I don't think so. He's in the same boat as everybody else trying to figure out where are we in this recession? Is it going to be maybe 2 or 3 quarters of slower growth or no growth? We haven't really called it yet because it's so perplexing to have this much employment. For every job, out there in America that is available, there's a ton of people that don't want it. I mean, you can't hire anybody anymore, which is incredible.
If the Fed is going to fight inflation successfully, you're going to have a big increase in unemployment and you're going to have a bad recession. But that doesn't mean it's the increase in unemployment and the recession that is responsible for the successful fight on inflation. It's not. Those things in and of themselves are not what's driving inflation lower. It's the Fed's inflation battle that is driving inflation lower, but is also driving economic growth lower and unemployment higher, but it doesn't mean those things are related. And the reason the Fed's inflation fight is going to cause a recession and cause a lot of people to lose their jobs is because we haven't had real economic growth. We have had a bubble. What has been the source of the bubble? Inflation. The Fed has inflated a massive bubble. It has kept interest rates artificially low.
The only thing the market has is monetary stimulus, and that's still a very sad reflection of the market. I know that it's liquidity in the market and everything like that, but I think that the market needs to stand on its own and prove that it's worth what it's worth at this level. But one thing, I can look over on my screen over here and roll around me, but I see some of the more speculative tech names going up. Tesla, the semiconductors I think are still overvalued. DoorDash, PayPal, little names like that. Even the meme stocks are just ridiculous. And until that excess is broken down and people just don't navigate towards those, then I don't think the Fed's going to pivot.
The bigger action took place in the foreign exchange market and in the gold market. We saw rather significant reversals on this reversal Tuesday. We'll see if this reversal has legs or if it's just a one-off event. Earlier this morning, the dollar index got all the way down to 105.05. Remember, I've been talking about 105 as a key level on this podcast for a while, and we got right down to 105 before the dollar reversed. It actually shot up 88 points on the day. It closed at 106.30, a very big reversal. The opposite happening in the gold market, also breaking a 4-day winning streak today. In fact, it looked like it was going to be 5 days up for gold this morning when we were up better than $10 an ounce early this morning. In fact, gold got as high as about $17.90 per ounce. So almost back up to 1,800 after having traded below 1,700, even around 1,780 on the lows.
They have no idea about money. And so if you don't know anything about money, how do you know about the inflation in the real economy? You can't. And so what they've done in lieu of technical proficiency, of any sort of understanding, workable understanding of the actual monetary system, they've kind of cobbled together this loose framework of correlations and sort of kind of maybe if this happens, then maybe this will happen. And we're kind of guiding our policy by a bunch of, modeled economic variables and thinking that, well, if oil prices go up, then maybe that'll have an effect on somebody's psychology and maybe they'll do something, then that'll lead to another thing.
We took a hit. We were at 20 and then it grew up to 23%. Then it went down to 16% of the portfolio. I mean, it was really volatile, but I've always said you're going to get this volatility in an industry that's not regulated because there's no institutional bid. So probably at the low, we're at 15%. We lost, 40% of the value. And now we've come back up on some projects and they haven't all come back at the same pace. The big players, the big market cap names like Bitcoin, like Ethereum, like Solana, like Polygon, HBAR, in some cases we doubled down. We took advantage of the extreme volatility in the large cap names like ETH and like Bitcoin. Why not add to the position if you're going to stay long? But, everybody trying to manage this space, I don't care who you are. If you tell me you made money in the last 90 days, I know you're lying. You've lost money and you're just averaging down, hoping for this to climb back up. If you'd owned these positions for more than 2 years, you're basically in a break-even situation. So this asset class is not correlated with anything, as people thought. It's not correlated with inflation yet, but the real problem, and every time you and I talk about this, it's really a gauge on where the institutional buyer is. And right now, zero. They have no Bitcoin.